Are you an investor who prioritizes capital protection over other criterion while choosing an investment avenue? Then here is a startling statement. Just because an investment is marketed as secure doesn't guarantee profitability. In fact, such schemes often limit potential gains in exchange for perceived safety. Are you willing to pay more to protect against a loss that may be more costly than imagined? In this video, let us explore the concept of secured investment. Welcome to holisticinvestment.in. Secured investment versus its purchasing power. For many investors, the allure of safe investment and guaranteed return is undeniable. The promise of securing both principal and interest can provide a sense of relief. However, it is crucial to recognize the hidden costs associated with such peace of mind and security. A safe plan may safeguard your principal and earned income. It often fails to preserve the purchasing power of your funds. Imagine depositing rupees 1 lakh in a bank today. Assumed rate of interest is 8% per annum. If the tax slab is 30%, then the tax liability on 8,000 interest income is rupees 2,400. The after-tax maturity value is 1,05,600. But with an inflation rate of 6%, that 1 lakh won't buy as much a year later because the cost would have raised to 1,06,000. But the value of our investment is 1,05,600. Despite the interest earned, your money's purchasing power diminishes. Real investment plans like mutual funds and stocks prioritize protecting the purchasing power of your money over simply preserving your principal. Just ignore the temporary shortfall and aim to counter inflation and generate long-term growth. Next, we shall look at the price we pay in order to ensure the security both in terms of principal and return. Schemes like Public Provident Fund offer a secure 7.1% return. PPF is considered as a secured investment as it is backed by government and it guarantees return and tax exemption. If an investor had invested rupees 12,500 per month in PPF for 15 years, the final maturity value is 39.9 lakhs. The same investment could be channelized into a dynamic investment like equity mutual fund where the potential yield is around 12%. Consider investing rupees 12,500 per month in equity mutual fund. The final maturity value at the end of 15 years would be 62.4 lakhs. Even after tax payment, the post-tax value is 58.4 lakhs. By prioritizing security over potential growth, investor may unwittingly sacrifice substantial returns. In this example, opting for a guaranteed return, that is PPF investment over an equity mutual fund investment could cost an investor 18.5 lakhs in potential earnings. Do you realize that you pay a high price indirectly for the sense of security by opting a so-called secured investment? Some of insurance policies in the market offer guaranteed returns of 5% to 6%. The sales pitch is guaranteed income for the next 20 or 30 years or for a lifetime. This persuades the investor. Let us assume someone invests his retirement corpus of rupees 1 crore in an annuity plan or pension plan offering rupees 45,833 per month till his lifetime. This may initially seem appealing, but they can quickly become shackled rather than shield. Due to inflation, the annuity will not be sufficient to meet the basic needs down the lane. Assume an inflation rate of 6%. If the initial expense is 45,000 per month, after 6 years, the expenses will increase to rupees 65,000. And after 12 years, 92,000. And after 18 years, 1,30,000. As inflation erodes purchasing power, fixed income fails to keep pace with the rising expenses, leaving policyholders financially constrained. The major drawback of these policies is your funds get locked. You cannot surrender the policy and get back your 1 crore. You are tied up with the investment for the rest of your life and can't use the investment for any other emergencies. Secured investments earn a fixed income. At the same time, they fail to protect the purchasing power of income. They couldn't combat inflation. That is why the investment that we feel as shield in the beginning turns into shackle in the future. Next, what is the solution to tackle inflation during post-retirement period? To combat inflation, it is essential to invest strategically. While fixed deposits offer stability, equity mutual funds can provide higher returns over the long term, helping to offset inflation and maintain purchasing power. Split your retirement corpus into 2 buckets. 70% in any debt instrument like bank FD, post office savings schemes. They offer guaranteed returns around 7% per annum. 70 lakhs in fixed income securities yields you a monthly income of rupees 40,833. Invest the balance 30% of the corpus in equity mutual funds, which can yield you around 12% per annum. Though they are dynamic in the short term, the chance of capital appreciation is high in the long term. If you invest the remaining 30 lakhs in an equity mutual fund that earns a 12% annual return, then the value will increase to 60 lakhs in 6 years. You can book profit of rupees 30 lakhs, add this to your debt bucket where you have already 70 lakhs. Now the debt portion is 1 crore. This will earn you a monthly income of rupees 58,333. 6 years earlier, you earned a monthly income of 40,833. The additional 18,000 will help you deal with the inflation. After booking profit, the equity bucket will have 30 lakhs. This will again grow into 60 lakhs in the next 6 years. Again book profit of 30 lakhs and add to your debt bucket where you have 1 crore already. Now 1.3 crores in the debt bucket yields you 75,833 per month. This investment strategy protects the purchasing power of income. In addition to that, you can enjoy liquidity as you have parked your funds in fixed deposit, post office savings scheme and mutual funds. Your capital is not locked. Guaranteed policies. Are the returns assured? It is crucial to understand the true guarantees of investment policies. Upon closer inspection, many so-called guaranteed policies may not deliver the promised returns because a portion of the benefits are only guaranteed. The investor may realize it only when the benefit is due. Most of the traditional policies are participatory policies where the benefits are based on bonus declaration. Investors should have a thorough knowledge of the benefits by reading the policy brochure before signing a policy. How to protect your investments? If you find difficulties in picking a right investment product or couldn't find time to manage your investments, it is better to consult a financial advisor. Based on your personal preferences, he will diversify your investment among secured debt investment and growing equity investments. We would like to conclude that ultimately, the right investment strategy hinges on protecting the purchasing power of your income. Rather than settling for plans that merely safeguard income, choose investments that generate income capable of preserving purchasing power in the face of inflation. This helps in wealth accumulation in the long run. A detailed blog post on this topic is available in our website and the link is given in the description. Hope you like this video. If you have any questions related to this or any other investment option or related to your financial goal, don't hesitate to book a free appointment with our financial planners. The link to the free booking is given in the description box below. Also, will you be interested to attend any insightful investment webinar? Then feel free to register for the upcoming enlightening investment webinar. It is completely free. The registration link for the upcoming webinar is also given in the description box. If you like this video, please give us thumbs up. Also, share it with your social circle. If you haven't subscribed our YouTube channel so far, please subscribe now.